If the most recent basketball tournament taught us something, it would be that past winners don't always end up on top. While the U.S. markets experienced a strong first quarter, international markets experienced an even better quarter. You can see that bonds and stocks had a strong quarter across the board. Bonds experienced a positive start to the year, up almost 3%, while U.S. large company stocks were up 7.5%, and international developed were up almost 8.5%. I'd like to take a few minutes to give an economic update. Here are the 4 charts that show roughly the same message. These charts are designed to assess the health of the economy by looking at key cyclical sectors. We show residential real estate investment in the top left corner, business fixed investment in the top right, light vehicle sales in the bottom left, and the business inventory to sales ratio in the bottom right. JP Morgan refers to the slide as the 4 horsemen of a recession, because the key trend to look out for across these 4 charts is the same. Usually there's one or more areas of the economy that become overextended or start to creep way above their long-term average, which is the dashed blue line on each chart, and may form a bubble that precipitates a recession. Currently, none of these sectors look overextended, indicating that if the U.S. does enter into a recession, it will likely be a mild one. The number of homes for sale is actually sitting about half the long-term average, meaning it's extremely difficult still to buy a home, even with interest rates way up. Plus, homes still aren't being built at even their long-term average pace, and it has been this way for 15 long years. This should continue to support the high housing prices we have become accustomed to. Unemployment remains very low as there are still more job openings than normal. Inflation continues its slow retracement downward. Shelter and clothing are currently the biggest drivers of inflation. So what does this mean for the Federal Reserve raising interest rates? The Fed raised interest rates by an additional 0.25% at its March meeting. However, it toned down its guidance on further tightening, signaling that the end of its tightening cycle is near. The Fed's dot plot you see here signals the potential of another 0.25% rate hike, but also that it would likely be their last. There is a growing opinion that the Fed will reverse course later this year and start to cut interest rates. See the green dotted line, that is the market expectations, versus the blue dotted line, that is the Fed's expectations themselves. Despite Jerome Powell opposing the idea of rate cuts, futures markets have priced in cuts for the second half of 2023, reflecting the concern that overly aggressive monetary tightening could tip the economy into a recession. Check out our written commentary for more information on the Silicon Valley Bank failure and some information on the debt ceiling that will be sure to make headlines over the coming quarter. Thanks for watching.